When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Fogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Fogan. And now here's Jeff Fogan and Jeff Shea.
Thank you so much. Welcome to Premier Retirement with Jeff Fogan, the radio show that gives you the straight talk and honest answers you need to reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about current events. We'll talk about the markets, also strategies to make your retirement savings last 30 years. We'll answer listener questions. And then finally, 10 problems to solve before you retire continued. My name's Jeff Shade. As always, I'm just here to ask the questions, but the words of wisdom and solid advice, they come from the other Jeff in this radio program. It is Jeff Fogan, founder and president of Premier Retirement Planning and Wealth Management. Hey, Jeff, how you doing today?
Doing great. How are you doing?
I'm doing great, thank you. Always glad to hear that you're doing well. Hope our listeners are having a great Saturday. It is the first weekend of August. Oh, my, where has the time gone? So we've got a lot to talk about here. We're going to start with the markets right now. Jeff, I saw a headline the other day that said the markets continue cooking with gas. The markets are really on fire. They've been on fire for a while. What is driving these markets week after week, month after month? Just when you think it can't get any better, it continues to go. What can we look forward to for the rest of the year and maybe on into 2026?
Well, yeah, I think it really goes down to just confidence that Trump's getting some stuff done that, even though I think there's a lot of BS coming out of the White House and the reporting, just like there is with any administration, they want to make everything look good. His is at least back with some sound business decisions that, look like we're going in the right direction. The deals that we're making with the foreign countries, before these tariffs are all ending right now. And, did they end? Are they, there's still a few loose ends out there, but it looks like people are coming to the table. We got UK and Japan a while back. We got the UK and the European Union. Looks like they're pretty much wrapped up, got a few others in the works. And I think everybody's going to finally come to grips with the fact that they're going to probably not get a better deal if they don't act now, because the deal's been getting better. It's part of the negotiation. The art of the deal is you start high and you work down to where you can kind of meet in the middle someplace. And I think they're meeting down around the 15-20% range. It looks like, instead of the 50 to 100% tariff range, because people, weren't willing to get off their horses and, make a deal. And they're finally coming around to do that. The market's not being rocked by it. What I'm really not sure about, and I think the earnings season that's just started a few weeks ago, and we keep getting reports of earnings beating expectations, but as I mentioned before, the expectations were dropped in a big way just since the second quarter when we had that big sell-off in March and April, and then they said, okay, well, we'll push the tariffs out till August, and then the market got happy again. Well, we don't have to worry about anything rocking the boat right now. Trump is committed to be the dominant player in the AI world, which means there's a lot of energy needs. So the energy stocks and nuclear stocks, a lot of things have been cooking pretty good. We've got, drone stocks and any of the technology that goes along with drones. Even, manned drones, autopilots for drone taxis, all these things that are getting developed are starting to get a little bit of traction. I do think, however, it's getting a little euphoric. There's a certain amount of overexuberance because of the progress. I think we're going to make that progress, and I think those earnings are going to come around. But, to be overpaying for stocks at the level we're overpaying is still worrisome. Even still, we've got some great returns on our growth portfolio. We've been beating the market consistently for the last 2 years. If you want to take risks, the thing is it worries me if somebody says, oh, gee, Jeff, you got great returns, I want to go all in. No, you could lose faster. And that's the thing I have to caution people is, we can lose faster in a down market than we can in an up market. We're definitely in what we call a risk-on position if we're in the market right now. The risk is higher and higher. It keeps going up. Does that mean it should go up? Well, I don't know. What depends on what should go up. It should go up if more buyers are interested in buying than sellers are interested in selling. And that's what's happening. But the fundamentals still lag. The economic indicators are still lagging. They went down. The jobs report's being a little bit manipulated like it always has been. It doesn't matter what party's in the White House. They love to tell you all the jobs that are created. There's another number, though. It's the JOLTS, or the household reporting, not ADP. ADP just says, this is how many payrolls we got. But that's mostly commercial jobs and people that actually farm out their payroll. and they do some sort of an extrapolation to say this is how many jobs must have been created based on the fact that we got this much payroll and we handle this many. The cross-section of payroll in the world is done here, so or this percentage is done here, so this is how many jobs must have been created. Well, it doesn't take into consideration, self-employed people that are contract employees that aren't doing payroll, that are 1099 employees, or that just the people that are out there, doing work for cash. We don't know what is really happening in the jobs market. I think the consensus by smart money is it's still weaker than being reported, although, the numbers that are being reported are the ones that are influencing the majority of investors, those people that are listening to the news, those people that basically are easy to just get hyped up and cheerled into doing whatever the market says to do. Fact is, the market can do what it wants to do when it wants to do it, and it always ends up doing the right thing. And we're at overvalued territories, and it'll probably do the right thing and correct eventually. I've been saying that for quite a while now. I know it sounds like a broken record. You just have to be cautious. If you can stand to ride some out, then the market's a great place to be with some of your assets, but not the assets that you need to live on in retirement, not the assets you need to pay your bills with month to month, and those sort of things. So, be careful on how much risk you take. I think the market still offers some great opportunities. Defense stocks are still doing well. You've got the nuclear-related energy-type stocks and infrastructure doing well. We've got some construction companies that are getting contracts for some of the infrastructure commitments by even foreign countries to bring manufacturing here, are starting to pick up in anticipation that they'll actually make profits, not necessarily that they're making extra profits right now. And so a lot of this is forward-looking. Again, stock markets that are always forward-looking. And right now we're paying a premium for stocks, hoping that all these promises made are going to be kept and that money's going to be flowing in, the economy's going to be turned around, we're going to be, going to the moon again economically. I have a feeling, though, that all these factories and infrastructure improvements and things like that we're getting commitments to, and a lot of foreign money committed to come into America to provide these projects, I'm afraid they're probably not going to get done on Trump's watch and somebody who comes in behind Trump, because by that time nothing will be done yet and everybody's going to complain that he's a failure, and then all of a sudden when everything starts happening that he's set up, the next administration is going to get credit and they're going to look like heroes based on all the things that he's setting up. So I think the market has a chance to kind of hold out and maybe not correct in a big way. History doesn't say that would happen, but we've got some interesting things going on, and of course the most dangerous words in the market is it's different this time, because it never is different this time. It just might take longer, or the cycle might look a little bit different, but the cycles have completed for the last 100 years, and I anticipate that they will again. I have learned to just believe in history. You typically follow the Fed. The Fed is a games player. The Fed is a puppet of the rich and elite class. However, they're not a government agency. So, we understand that they can manipulate the market by adjusting interest rates, money supply, and things like that. And they've done a really good job on that. I think they're running out of tools, especially with the pressure that Trump's giving Powell to lower interest rates. The thing is, he can only lower the short-term interest rate. He can't just, blanket say, the 20-year bond is now going to pay this much, and all of a sudden make bond prices go up or down. But, bonds have been falling. That 60-40% bond split, if people are still in that kind of an allocation for the last few years, and I meet so many people that are, they should have been out of bonds a long time ago in 2022 when the interest rates started going up. You need to get out of bonds. Interestingly, there's starting to be a little bit of a flight back to bonds from smart money because they're going into it. And the only reason they would buy bonds, which are in a downtrend, is if they believe that it's a less risky proposition to be than in the market. The other thing we've seen is gold miners, silver, all the precious metals have outperformed not only the market, they've outperformed bonds market by, multiples, not just by a little bit. It's like up 30% for the last year and compared to, 8 or 10 for the market. So we're looking at a lot of smart money buying hedges, and that does mean that the smart money realizes that there's some questionable fundamentals propping this market up. In fact, I don't think there are fundamentals propping up the market. It's just wishful thinking of the future and downgrading earnings expectations so that they look better than they were going to look, even though they're not as good as an economy that's growing at, or that has price earnings ratios of 30+% on average. $30 per share, you're paying $30 per share per dollar of earnings or more. It's actually like 38, almost 40 now. We haven't seen these levels since the dot-com bubble. The dot-com bubble, however, there was a lot of companies that just had .com on the end of them, had no revenues, no income, nothing but a name. And it was a lot of fake money, kind of like Bitcoin is. But, there you go. That's another economy in and of itself that just somehow throws a value of dollars on something that was made out of a password in a computer that generated a number, and all of a sudden it becomes money. The dot-coms are kind of like that. You put a dot-com on the end of it, and all of a sudden it becomes money. The difference between AI and why I'm a little hesitant to just, say Chicken Little, the sky is falling, it's just like the dot-com era, is because there actually is earnings. I mean, they are building chips for AI. They are building power plants for AI. They are selling power. They are actually pre-selling power and making commitments for energy. The big companies, the big sevens, the Amazons, Microsofts, Googles, everybody is, already lining up all their energy suppliers. And, building that infrastructure is going to create jobs, going to create money. But I think it's very sector driven, not very broad based. And when we see consumer purchases like discretionary purchases, near all-time lows as far as how much people are spending on extra things, even cars, the discretionary items, washing machines and, bicycles and all the different things that people use for disposable income are the ones that are seeming to be suffering the most. We're seeing stores like Costco, stocks, in a downtrend. It's a great short play right now. You got stocks like Dollar General or Dollar Tree going up. Yeah, that kind of gives you an indication that people are not as flush with cash as we would think. But the rich people have plenty of cash to play in the market, and there's people that do have discretionary income that are continuing to throw it at the market and drive the market up. When there's more buyers, the market goes up. When there's more sellers, the market goes down. And eventually, I think, the market might run out of gas, and it says it's running on gas. I don't know where that gas is coming from other than, Jim Cramer blowing his hot air on TV and some of these other people that just talk about how there's no end in sight for the market. But when I see companies that a year ago were, I felt fairly valued with a 20 price earnings ratio, and they're growing at 10 to 20% a year. Now they're growing at 10 to 20% a year, but their price earnings rate is 40 or 45 or 50 on a price earnings ratio. What I mean is that we're just paying a lot for that stock. We're paying twice as much for that stock, given a similar growth rate to what we paid half for it a year ago. It isn't like their growth rate or their growth prospects doubled in many cases. Now, there are some companies out there that do. There's also companies up there that are so big that they can't, it's unreasonable to believe that they could double production, double revenues, double income in any period of a few years. We're talking probably in some cases decades, yet their stock doubled or is on the track to double in a year or less. That doesn't make sense to me, and that is scary to me. If I'm a safe money guy trying to protect assets for retirement, I need to be cautious. We need to be sure that if you're going to go play in this market, you're playing with money that you can afford to lose or wait on, and that you can't throw it all there just because everybody else is, and just because your golf buddies say they're making a ton of money in the market doesn't mean you ought to throw it in, especially if you haven't already been in it for a while. The market can retrace 20% and you're still okay. But if you get into it now and the market goes down 20 or 30, and that's a big chunk of your assets that you plan to live on, chances are you're going to get scared and get too scared to go back in anytime soon, and you'll probably miss the upside when it turns around. So, everybody's got to reassess their own situation. The market's looking really strong. I don't think the fundamentals support it. It's mostly hype, as it has been for a few years. And it's a lot of the bank money. I mean, they're not loaning money for you to buy houses. Nobody wants to borrow at 7 or 8% for a house. Mm-hmm. They're not loaning money on cars because nobody's buying cars like they used to. They're trading stocks. They're buying their own stock back. And, the banks are kind of creating their own little economy, making things look a little bit better than they are. So we have to be careful. But at the same time, if you have some money you can risk, maybe you can jump on the train for a little while. But just be nimble and be ready to jump off when things look like they're getting sketchy. And I think we're kind of at that choppy range where you've got to be very careful you want to play this game.
Talking with Jeff Ogan of Premier Retirement Planning and Wealth Management. Of course, we're talking about the market and the economy and your journey towards a confident retirement. Again, questions 520-780-9059 is our number. I think the bottom line for investors, Jeff, is the market may be upbeat right now, but selectivity is going to be the key here. So favor areas with macro tailwinds: healthcare, equipment, logistics, AI, infrastructure, industrials, consumer discretionary, tied to globalization. Again, we cannot give direct recommendations, but those are just general areas. And watch for central bank messaging, upcoming inflation, and jobs data closely, because those do remain critical triggers for rate expectations and equity valuations. Again, if you'd like to talk to Jeff about what's going on in the market and the economy, how it affects you, 520-780-9059 is your telephone number. You can make that call right now if you want, 520-780-9059. Leave your name, telephone number, and Shelley will call you back during the week and set up a time for you to come in and sit down and talk with Jeff. It's just a casual conversation, just an opportunity for you and Jeff to get to know each other and for you to ask the questions that you need the answers to. Again, it's not going to cost you anything, totally complimentary. There is no obligation and certainly no judgment. 520-780-9059. You can also request your Premier Retirement Roadmap online at premret.com. checkup.com. Jeff, let's continue our program here by talking about strategies to make your retirement savings last 30 years. A lot of folks talk about the 4% rule with withdrawal rates. Is that still relevant for a retirement that could last as long as 30 years?
Well, they've done some studies just recently, especially since the lost decade in 2000 to 2010. A guy named Wade Pfau, who actually created a major in college that's called the Retirement Income Specialist. And there's actually a designation you can get for retirement income specialist. I've been a retirement income specialist since before the designation existed, so I don't think I need to go to school on that one. But
no.
I certainly do read his studies and enjoy the confirmation that he's given us who are into the income game that volatility kills income, period. And after that lost decade, he says, if you'd have retired, at 2020, and we have another lost decade before you end up being dead, in other words, a 30 or 40 year retirement, which is feasible for somebody in their 60s to live to 90 or 100, then you've got about a 1.8% withdrawal rate is the right rate to not run out of money in a statistical probability way. The 4% rule was built in 1993 by a guy named William Bangen, who basically used a 10% average rate of return for the stock market and about a 6% rate of return on bonds. Well, we know that for the next 40 years, starting before he made that rule, but for the next 30 of those years, rates continued to fall, which meant prices went up, but the rates kept going down. So if you're going to ladder bonds and rely on a 30 or 40 or 50% allocation in bonds that are generating 1 or 2% like they were up till just a few years ago, you're not going to have the same withdrawal rate as you can. The other thing is if interest rates start going up like they did after the inflation started in 2022 and you start losing 20 and 30% on your bond portfolio over the next few years, like most people have, if you look at your bond portfolios, they're probably down 20 or 30%, which has really offset any of those gains that the market's made back after it crashed 20 or 30% in 2022. So bonds have really been kind of a sticky mess when it comes to income planning, when they were supposed to be the fixed income asset category that people are supposed to build their income portfolios with. Well, at 2 or 3% interest and the chance that you could actually lose money on bonds every time you have to sell a bond early, and if you can't wait to maturity on a bond, you're going to lock in a loss. Same with stocks. Every time the market goes down, if you're liquidating stocks to live on, you're locking in those losses. And when the market goes up, you're only locking in gains on the money that you spend, but everything else that's left in the portfolio can still go down. Those gains are nothing until you pull that money out. So based on volatility, that 4% rule, came around in the early 90s based on the dot-com bubble that burst. And then the following decade, which we call the lost decade, where the stock market crashed 2 times, ended up at 0 rate of return from 2000 to 2010. The 4% rule has been totally out the window. Now, interestingly, just about a week ago, maybe 2 weeks ago now, I saw a paper from Schwab. In fact, I had to get it and be able to print it out. If anybody wants to call and get that, we can probably find it for them. Maybe we'll put it on our website. But it's the 4% rule is dead, and it came out in the low to mid 3s was more of an effective withdrawal rate. Schwab says, the 4% rule, that's way too high. And they dumbed it down quite a bit. And I think they used some other assumptions, maybe not including inflation, maybe not including, increasing your withdrawals over the years. I'm not sure. I haven't read the whole thing. My son, the accountant, CPA, who looks at all the number stuff, pointed that out to me. And we're going to try to get a copy of that white paper to be able to distribute it to our clients, just to remind them that volatility kills income plans with the 4% rule is dead. What I think is interesting is 4% is less than the average bond yield over the last 30 years. It's way less than the average stock yield over the last 30 years. Why can you only pull 4% out? And the answer is simply volatility. You don't want volatility to be any part of your income plan. And that's why we like annuities, insured products. We like the annuities that pay guaranteed income, that don't take into account any volatility because they're principal protected. You can either get an annuity that pays a flat rate of 5-ish% and just pays you out over a period of time. You can get an annuity that pays you up to 10 or 15% in a good year and 0% in a bad year, based on different markets, different indexes, different leveraged indexes, and all kinds of new things that have come around in the last few years that are very creative ways to protect assets and make some upside so that these insurance companies who guarantee income can guarantee way more than 4%. For somebody in their 70s, you can guarantee probably 8 or 9% guaranteed annualized rate of return. And if the money runs out and you're 90, you still get the paycheck. If it ends up performing like the companies think they can perform, you can either get a raise or you end up passing on to your heirs the money that's left in the account, and it might end up being more than what you started with. So there's ways to play the retirement game that have nothing to do with stocks and bonds. The Wall Street hates me saying this, and anybody who does opposing radio shows really loves to tell you why you shouldn't buy LERPs and annuities because they're horrible. Well, honestly, over the next 30 years, if I manage your money, I make a lot more on that than I do selling you an annuity that pays your bills for the rest of those 30 years. Am I being a saint by doing that? No, I'm making my clients happy and secure so they want to hang out with me for the rest of those 30 years. Our business model works just fine. I think you can allocate, half your money or 2/3 of it or 1/3 of it or however much you need to supplement your guaranteed income from pensions and Social Security to make a guaranteed income that you can live on, that you don't have to worry about at the end of the month whether your bills are going to get paid or whether you're going to have to cash in an investment and take a loss on it because the market's down. So I think the Wall Street model is broken. I learned that, I was an engineering major, so I'm very analytical. I know numbers, I know math. I just happen to be really good at the financial wing math, so I changed my majors right at the end of my college career. Love the numbers, so I analyzed the numbers. And, when I figured out, the numbers after, just a few years in the market is like, this doesn't work. This volatility stuff doesn't work. I've got to look for a different way to protect my client's asset. Wall Street model, it didn't make sense to me after a few years where we were just, being hyped to buy and sell stuff that had a potential to go up. And if you just set it and forget it or buy and hold and had forever to just let it grow, yeah, the stock market's a great place to grow wealth. But I noticed that the people that needed money had to sell at a certain interval of time, whether it's monthly, quarterly, maybe it's just during tax time, maybe it's just a big bonus for a Christmas present. I don't know, whatever. Anytime they had to take money that basically they weren't in control of, the market was up or down and they either took a loss or they took a gain, and, the market was in control, not the client. So, I decided that if I wanted to really protect those people that I kind of felt myself caring about the most, and that was the people that were most vulnerable to, losing their retirement dreams and losing the American dream of living a financially successful and financially sound, confident retirement life, I knew that the stock market alone wasn't the way to do it. And, since then I've also learned, and everybody's learned, that bonds are not the alternative. Bonds can also go down. We've learned that in the last few years in a big, big way. And, why not transfer that risk to somebody that's used to transferring risk to? Those are insurance companies. They'll guarantee your income. They'll guarantee your principal. They'll guarantee it even on a LERP, life insurance, which is a tax-free version of an annuity that you can do outside of IRAs, that you can ladder different investments into and receive what I call stealth income that doesn't even show up on a 1099, doesn't show up on your tax return, doesn't go into the calculations for means testing to justify the Medicare premiums to go up or the IRS to charge you more on your Social Security taxes or not give you those tax-free benefits that Trump promised that only affect, the lower income people, not the higher income people. Well, what if your higher income came as stealth income from tax-free investments that don't even show up on your tax return? Well, maybe you can take advantage of those tax breaks as well on Social Security because you don't show up with a lot more income, even though you live on a lot more. So again, the 4% rule, to go back to your question, is dead and has been replaced by much better, tax-adjusted rates of return that are much better than 4%, that are guaranteed, bring more peace of mind and confidence in retirement, and generate more spendable cash in the long run. Oh, and they don't affect those means-tested benefits that you get that you're technically entitled to because they are your money, Social Security, the Medicare premiums you've paid in, yet everybody pays a different price for their Medicare insurance based on how much they make or how much they declare that they make, which is unfair. We all paid in a certain percentage of our, if we had a high income when we were working and we paid more into Medicare, we had to get more. We had to not have to pay more again. It's a bad deal. It didn't turn out to be a good deal. So we can mitigate those problems or those inequities by just allocating your money to different assets that generate income in different ways and don't have anything to do with managing risk with a 4% rule or a 1.8% rule or a 3% rule. You can live on a lot more income. We've seen that just, in the last few days. We've showed clients how, on the 4% rule, they might be able to live on $100,000 a year, counting all their income sources, and we can bump that to $150,000 a year and still give them, the peace of mind that they're going to leave their heirs a nice chunk of money and not have to dig into, a lot of the assets that they thought they'd have to spend, or at least to protect, or at least to set aside for the buffer to protect their income should there be a market downturn or should there be volatility, et cetera. So again, there's different ways to skin the cat. We like using all the tools in the bag. We like building our financial house with all the tools and all the materials and all the different products and services and amenities that are available to us in the financial world.
We're talking about creating an income strategy so you don't run out of money for a 30-year retirement. In summary, We've talked about the 4% rule. It could be the 5% rule. It could be the 3% rule. We just have to take a look at your situation, figure out which is best for you, and certainly be flexible because we may have to adjust that as your retirement goes on. You can also delay Social Security if you want. Delaying Social Security sounds good, but there can be some detriments to that too. We'll discuss that with you. Also, we'll create an income floor with annuities. Jeff talked about that a bit, and we'll manage withdrawals to minimize taxes. There's so much that can happen here at Premier Retirement to make sure that you do not run out of money in a 30-year retirement. So to recap, flexibility, smart timing, long-term plan, those are the keys to lasting through this 30-year retirement. If you have questions, again, 520-780-9059 is our telephone number. 520-780-9059. Make that call right now if you want. Set up your appointment with Jeff. No cost, no obligation, no judgment. When you call that number, all you've got to do is leave your name, telephone number. Ashley will call you back during the week and find a convenient time for you to sit down with Jeff. And again, it is just a casual conversation. No cost, no obligation. 520-780-9059. You can also request it online at premret.com, premret.com. Jeff, let's take a break. When we come back here on Premier Retirement, we'll be answering listener questions, and then later on, we'll continue our conversation about problems to solve before you retire. Continue. When our program continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shea.
Thanks so much for making us a part of your weekend. You're listening to Premier Retirement with Jeff Hogan, founder and president of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. We've been talking about current events today. Also, how to make your money last for a 30-year retirement. If you've missed any part of the program, remember we're also a podcast. Go to wherever you get your podcast, search for Premier Retirement. You'll find this show and many of our past shows so you can stay on top of your journey towards growing your wealth and a confident retirement. You can also hear us on the radio 4 times a week. We're on Saturdays at 7 a.m., 9 a.m., and 1 p.m., and then on Sundays at 11 a.m. Our telephone number right now, 520-780-9059. If you'd like to give us a call, set up an opportunity for you to sit down, have a casual conversation with Jeff about whatever you want to talk about insofar as growing your wealth, protecting your money from taxes, and, of course, having a confident retirement. There is no cost and there is no obligation for that. 520-780-9059. Okay, Jeff, time for listener questions this week. We will kick it off with Mark, who's listening to us right here in Tucson. I'm 66, retired a few years ago, left a substantial portion of my retirement assets in a 401k plan with my previous employer. Recently, the employer discontinued 2 Vanguard investment options, a money market fund, and a short-term bond fund. To replace these, they added a new fund called the Voya Advanced Intermediate Stable Value Fund. This currently has a 4.92% APR, 30 basis point management fee. Apparently, stable value funds have become more popular in a 401k plan. My question is, would a stable value fund be more of a quality food, or would it be sort of like a Twinkie type investment? Empty calories. Any insight you can give would be appreciated.
Well, that's interesting. We've been basically using a stable value allocation during this market weirdness that we've gone on pre-election. And most people that, if they're really worried about the overvaluation of the market, we've been in an allocation that's very similar to that. So it's nothing new to us. And, I think these stable value funds, now that short-term interest rates are, in the 4 and 5% range, they make sense. I don't think they made sense when it was 1%. You could just keep it in savings in the bank and make 1%. Well, maybe you couldn't. But, the point is it wasn't very enticing to really move money back and forth between a bank and a money market, both paying under 1%. But now that you can move into stable value, if you can't get a high yield interest at your bank at 4 or 5%, or you're not able to buy high yield savings or CDs at your 401k, the stable value is the alternative to that. So I think it's a nice thing that people are getting more aware of. There's a lot more companies that are investing in more short-term corporate bonds, even some short-term high-yield bonds that are kind of enhancing the rate of return to get up around the 5 or 6% range. We're using those, day in and day out. We like them, and so I don't have any qualms about them at all. I think that's a great way for if you want to keep your money safe and kind of wait for the market to correct and do what it probably will end up doing in the next couple of quarters if it's going to do it, and if it doesn't, then maybe you start gradually getting back into the market if you feel like taking some risk. If not, it's a great way to hang out. At least you're keeping up with the current inflation levels. Even net of fees, if you have to pay an advisor fee, 1% or so, and you have to pay your fees for the fund or for the 401k, you're still netting, a keep up with inflation and keep your money safe type return. So again, those haven't been available that long, just in the last couple of years. They're a trend that people are going to. We've certainly been going there for quite a while. So yeah, good question. And it's a legit deal. It's I would say a quality food, not a Twinkie.
All right. Mike, thanks for listening to us in Tucson. Of course, we'll send you out Jeff's book, Retirement, The Road Ahead. And we appreciate you listening to us. 520-780-9059 is our number if you'd like to come in, Mark, and sit down with Jeff on a casual basis. Next question comes from Sal, listening to us in Green Valley. Sal writes, I have a question for you. What are your thoughts around indexed annuities with a guaranteed downside protection? I'm considering investing about 20% of my IRA assets into an annuity that's tied to the S&P 500. It guarantees 20% downside protection, has no explicit fees, and pays out in 6 years. This is long-term money that I don't have to touch for many years. What's your opinion on this? Now, Sal doesn't give us his age, but let's say that Sal is 62 years old.
Yeah, Sal, this is kind of an interesting new phenomenon. The variable annuity industry is very fee heavy, and they really hate the idea that there's indexed annuities that have no risk to principal, have good upside, and charge very little, if any, fees on them. There are no inherent fees. It's going to be, believe me, there's fees. There's something inside of it. This is a variation of a variable annuity. They're always expensive. They are, period. The math doesn't work for me. They are called buffered annuities. They also have structured notes that do buffering. The fact is you can still have guaranteed downside protection, meaning the most you can lose is 20%. Generally speaking, if you hold it long enough, you're probably not going to lose 20% anyway. That's just going to be for a short period of time. Yet, if it's a 20% on an annual guaranteed, return, in other words, if the market falls 30, you get down 20 and you start over there. So it takes 2 10-year upside years to get back to even. On an indexed annuity, let's just say, you had 2 upside years of 10% after you didn't lose any money and you made 7% instead of 10% on those. You're still up 14 rather than getting close to breaking even. I like guaranteed. I just like guaranteed, simple principal protection to be principal protection. If you're going to take a 20% downside, what I would do is just say put half your money in the S&P index, pay little or no fees, and put the rest in a safe place like the last question, in a no risk 4 or 5% rate of return asset where you could always grab money if the market was down. And so if the market goes down 20 or 30, even if it goes 50, it's going to bounce back and you still have, half your money you could spend while the rest of it's, recovering, from some sort of a downside. And you'd pay a lot less fees for it. Certainly a lot less commissions for it. Variable annuities typically pay a nice fat commission up front. Not fat, but reasonable commission up front. But what I say is fat because there's residuals too, and you keep on having to pay over and over again, commission or a fee. It's kind of like you get a commission up front and fees. What I always tell our clients is, sometimes ask, how do you get paid? You get a commission on that. Yeah, but if we get a commission, we don't have anything that gives us a fee. We either get a commission or a fee, or in other words, we get an upfront or a trail. So it just depends. But typically, it's between us and the company. It doesn't affect the way you get paid. The product's going to be the same. The product's going to be the same on variable annuity, except and all these buffered annuities, except the fact that you're going to see some sort of a fee or a margin being taken out of that. So, I'd love to see a buffer on the 20% downside that has no explicit fees, maybe no explicit fees, but there's a structure where they get paid. Believe me, every company does, even the fixed companies do. But when the fixed companies, I say fixed meaning the principal guaranteed has zero risk to your principal, truly principal protected. They are taking a lot less risk for your money, so they don't have to build in fees to buffer their losses if the markets turn bad. And the thing with anything that allows you some sort of a protection is either going to pay you a little less on the upside or give you a little bit less protection on the downside, but somehow, build a fee in it so that if, the insurance company's money is out on a limb, they're going to have a chance to recover that as well and not lose. They've got to buy options and things like that to protect the downside of those assets, because they're investing some, in order to give you a higher return, they're actually investing 20% of your money or maybe even more in the market itself, hoping that, it doesn't go down, but knowing that if it does, they're taking enough fees over the contract period that they're going to make up the difference to cover any losses. So be careful on those. I'd love to compare them line to line. I haven't seen one yet that I would buy instead of a totally principal protected asset. I would rather have you have 50% of your money in a total principal protected asset and just do it yourself and put a little bit of your money into something that's more of a tactically managed account. If market starts going down, we rotate out of the market and, sit on the sidelines for safety. Market looks like the momentum's going back in the market, we go back in. This annuity is, well, basically you've just bought a program that you're going to be in the market for 10 years and have a 20% risk. You might be able to do a little bit better than that. Just manage it on your own, like I said. So again, it's several ways to skin the cat. The thing with these annuities that have buffers or that have certain downside assets, they're offered through the brokerage industry, and the brokers allow their agents or their reps to sell these because of the fact that they not only pay upfront commission, but they give trail commissions and trail fees. And the broker dealers don't mind giving up assets that they would otherwise get a fee over and over again on the same money forever to another product that gives them the same thing, yet is maybe easier to sell because they can provide some sort of a buffer, some sort of a downside protection guarantee. Well, I don't know. I don't think it's worth the money, honestly. I don't think it's worth the trade-off. And I think there's different ways to structure your portfolio to where you have more than a 20% buffer in downside protection, yet have more of the upside than what these would offer.
Good question, Sal. Thanks for listening to us in Green Valley. And, of course, we'll send you out Jeff's book, Retirement: The Road Ahead. Next question, Jeff, is Katie listening to us in Casa Grande. Katie says, where should I pull money from when I first am in the decumulation phase of my financial life? I have money in stocks, bonds, mutual funds, and smaller amounts in CDs.
Well, it kind of depends on what you're making on each of them. In the decumulation phase of your financial life, I like things that are a little bit more predictable, guaranteed. That's why I like to structure my income into annuities and LURPs so that you can, know that in a bad market, they're not going down. I like, the stocks, if you have a stock and I don't have anything in bonds other than short-term bonds right now. So, maybe you spend some of that if you think the market's going to go up. Maybe you take some profits out of your stocks right now because the market's high. Maybe you live on that this year. Again, every year is going to be different. We do a 30-year plan and we structure our income plan so that you know where you're going to get income regardless of how all these other things are working. You have smaller amounts in CDs. Well, it looks to me like that's the only safe money you have that you can guarantee take money out without a loss next month if the market's down. The bond market could be down. It's been going down consistently since 2022. Stocks going up, but they could flip on a dime. I mean, we had a really harsh early spring this year, and then they said, never mind, we're not doing tariffs, please go buy the stock market. And they rallied the market and sure led the market, and all of a sudden we're off to the races again. But that doesn't mean it can't fall just as fast next month, and then all of a sudden all your mutual funds are down, your bonds are down, your stocks are down, and you need a chunk of money because you have a cruise plan with your best friend and it's going to be $30,000 and you didn't realize that the market would go down, and now you have to take a big loss on the money to pull out. So again, and if it's bill paying money, I don't want that money to be in any sense of the word in a variable type of an account. Right now, in my opinion, you don't have any money that I would use for decumulation phase creating income. You don't have that account set up at all. All you have is the traditional Wall Street way. And I'm not trying to dog on you, Katie. You've asked a great question, and that's what I think makes us different than the typical Wall Street firm. They want to keep making money over and over again on money, and they don't care that you take all the risk as long as it's in stocks, bonds, and mutual funds, and it goes cha-ching, cha-ching, cha-ching every month. And hey, the market does what the market does, and sorry it's down this month, but oh well, maybe better luck next time. And if you run out of money, it's no big deal to them. Well, I mean, maybe it is to some of them, but I don't think it is to the institution itself. They couldn't care less because all they care about is, okay, how can we maximize the chance to make money, and we don't care about risk. Now, that's a great way to accumulate wealth. You've got there to the fact that you're talking about decumulating, meaning that you're probably right on the brink of retirement if you haven't already started. The market has been holding out reasonably well lately, so you haven't been hurt yet. But there's a lot of things that I would be worried about having your allocations. If the majority of your money is a stock, bond, and mutual funds, I'd be really worried about you trying to take an income plan off of that unless you have pensions and Social Security making up all your income needs.
Katie, thanks for the question. Of course, you'll get Jeff's book, Retirement: The Road Ahead, and we invite you to give us a call here at the show, 520-780-9059. That'll put you in touch with Shelley here at Premier Retirement. Shelley will call you back and set up a time for you to come in and sit down and talk with Jeff, have that casual conversation to continue to ask the questions that you need about withdrawing money and in which order in your retirement. You're calling it the deaccumulation phase. I like that. 520-780-9059. Of course, primret.com is our website. Jeff, let's continue our conversation here. Last week we started this about problems to solve before you retired. So I want to continue that conversation right now. The next one that we have to solve before we retire, at least think about, I don't know if we can solve it completely, but that's going to be taxes in retirement. A lot of retirees get surprised by taxes on Social Security and RMDs and capital gains. What's the strategy there before you retire?
Well, I mean, whether you retired or just before you retire, I mean, obviously, the sooner you start on any planning, the better off you'll be. You know, my philosophy is pay taxes on the least amount of money at the lowest tax rate possible. I mean, that makes sense, right?
Right.
So some people are just hell-bent on getting the best tax deductions they can this year, not worrying about what happens next year. And pretty soon you're kicking the can down the road, then you're kicking all the cans down the road. You get to 73 and you have to start taking income out of your IRAs, 401ks, and qualified plans. All of a sudden, you're in this huge tax bracket you never expected. Well, what if while you're taking Social Security in those early years, rather than live on savings and live on after-tax money and have zero taxes between age 65 when you retire and 73 or 75 when you finally start taking those retirement distributions, maybe you spend a big chunk of that and pay taxes at the 22% tax bracket. Maybe in 5 or 10 years, you could move all of your millions of dollars out of IRAs and pay tax at a 22 or a 24% tax bracket, convert it into Roth IRAs, convert it into LIRPs, life insurance retirement plans, convert it into after-tax income streams where you can, even annuities where you can get what's called an exclusion ratio where only a portion of it is taxable. And you can actually determine your future tax rate, or at least your future taxable income right now. What if you can move a couple $1 million out of IRAs over the next 5 or 10 years and pay tax at 22% and still have a couple $1 million in assets at the end of that, and then end up living on $150,000 a year for the rest of your life and pay taxes on almost nothing? I would rather do that rather than say, well, that $2 million is going to end up being $5 or $6 million in total income between now and the time I pass away. And if I don't spend it, it's still going to be passed on to my heirs taxable. You're going to probably always be in that 22% tax bracket. So you want to pay 22 or 25 or even 30% tax on $6 million worth of income streams over the next 30 years? Or would you rather just pay it in the next 10 years at that bracket and then live tax-free for the rest of your life? If you do the math, you'll find out you're saving hundreds of thousands of dollars in actual taxes and probably leaving your heirs hundreds of thousands of dollars and more in net income. And during that time, be able to spend a little bit more in net spendable income on a monthly or annual basis. And we put it all in a spreadsheet so you can see how the math works, and you can see the math works before you make the decision to jump into a plan like that. You don't have to swing for the fences and make a ton of money if you're saving a bunch of taxes. If, let's say, you're hoping to make 10%, but after you pay taxes at 20 or 30%, you end up living on, let's say you're making $100,000 a year in income, it's taxable, you live on 70. Well, that $70,000 of net taxable income, oh, by the way, that $100,000 in income also pushed your tax on Social Security to a higher bracket. Oh, and you just became in a higher Medicare bracket, perhaps. Well, what if you got rid of all those future taxes before you started Medicare in your early 60s by just taking extra distributions or converting assets to a Roth IRA or a Roth 401k, even while you were working, and were willing to pay the taxes on it while you were making money so that you didn't have to pay taxes on the future? Now, what do you have to have? You only have to make $70,000 tax-free, and you don't get all those extra surcharges. When the government comes to tax you or surcharge you or means test some sort of a benefit or income that you're getting, they don't even see some of that tax-free income, and it doesn't affect you. Taxes in retirement are a big surprise when people retire, find out they don't have kids to write off, mortgage deductions, all the things that you used to be able to deduct maybe because it was work-related or maybe you had a side business that you're able to run some deductions through. And now all of a sudden you don't have any deductions, you don't have any extra mouths to feed, and everything you earn is taxable. And there's only so much in standard deduction you can take. The rest is all going to be hit with a premium to the IRS. So tax planning, taxes, first of all, can be a surprise in retirement. Many times people retire and find out they're in a higher tax bracket than they were when they were working, Or if they're not in a higher tax bracket right when they retired, they work so hard on keeping their taxes down as soon as they retire that they end up getting surprised later with RMDs, capital gains, other things that hit them later at a much higher tax bracket than would have been had they just made a plan to ease out of their tax situation over a period of a few years rather than kick the can down the road and then be hammered for the rest of their lives.
Problems to solve before you retire. That's our topic here with Jeff Hogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. Next one is Social Security timing, Jeff. Taking it too early or too late, it really can significantly affect lifetime income.
It can. The best way to maximize Social Security, obviously, is wait as long as you can to take it and then live a long, long time. However, that doesn't always, work into somebody's perfect plan either. If you spent all your savings and all your IRA money and 401k money just to get to age 70, then you have no savings. So you have to really optimize your, Social Security to work within an entire plan. Some people just use it as a one-off plan. It's, my Social Security plan is X. Well, how does that work with all the rest of your planning? How does it work with all the rest of your spending? How does it work with your tax bracket? Are you going to continue to work during retirement? Do you have one spouse? For example, I had a guy that came to a seminar up in Show Low way back in the day when I used to go up to do stuff in the summer. Now I just play in the summer, but we used to do seminars up there and had some clients. We'd follow our clients up there in the mountains. Anyway, so he comes in, he's breathing oxygen, and I'm going like, dude, why this guy's like out of his elevation zone? He shouldn't be up here. Right. But he comes up to me after a seminar and says, I'm just wondering, he's breathing hard, and he says, I'm wondering if I should take my Social Security. I'm going to be 62 tomorrow, and I can take Social Security. You think it's smart? And I'm looking at him, with this little oxygen tank that he's, carrying behind him. He's struggling to breathe. He's kind of a little overweight dude, but looks like he's in reasonably good health. And I'm thinking, well, yeah, duh. Crap, you don't look like you have too many years left. Take it, and that was my initial thought. But, they set an appointment. We went and met and talked, and it turned out his wife was much younger than him in good health. And she was, doing had her own little business. And, he says, well, I'm worried because I understand that, she immigrated from Mexico and hadn't been here a long time, hadn't worked a lot, had her own business and was doing okay to support the family at the time. He says, well, the thing is, if I take mine now and if I die, if I don't make it, I'm going to leave her less than if I just wait, right? Wouldn't she get more if I don't even take it, as long as we can pay our bills? And, if I can make it 70, take it at 70, and then I die, she gets my amount, right? I'm thinking, oh man, it's too early in my career to have really gone through that many scenarios, and I hadn't really thought about that. But, in his case, it might be really smart, even though it makes sense on the surface to take it early, but it really made more sense for him to wait as long as they could make ends meet in the meantime, because, chances are in the next 10 years, she wasn't going to get enough earnings to make her Social Security bigger than his Social Security. He had a pretty good job. He had really high Social Security, took a little bit of time off early because of his health, but don't remember if he was on disability, workers' comp or whatever. But bottom line is he decided it made more sense to try to wait. Okay, well, that played into their plan. Now, so other people say, you know what, I don't know if Social Security is going to be here forever. Why don't I just take it now and I don't need it, but I'm not working. How about I just reinvest it for the future and we can, save it in that way? Now, that's another option that, this guy could have done as well. I think I was a little bit less worried 20 years ago about Social Security trust fund going broke than I am now. Obviously the writing's on the wall, and they've already told us Social Security is getting diminished pretty quickly based on the fact that people are living longer and they've had cost of living adjustments, and they're drawing down that account. So, maybe it makes sense if you're worried about the longevity of Social Security trust funds to take everything you can get, start early, and reinvest the money into something that you could annuitize into income at a higher rate of return than Social Security. Whenever you take Social Security, if you live 12 years, you would have actually got more out if you would have waited. In other words, you kind of locked in. Now you're at the point of break even. It's about a 12-year break-even point. But what does that mean? If you spent the money, that's different than if you reinvested the money. Maybe if you reinvested the money, you do better, because maybe over a 12-year period, you dollar cost into the market, and the market averages a much higher rate of return than the 6 or 8% that they increase your Social Security, for that same period of time. But then again, we could go into a lost decade where it goes up and down, and you don't really do that well in the market over that period of time. So nobody has a crystal ball. It kind of is a crapshoot, but you need to take into a lot of things into consideration: your health, your longevity, whether you have a spouse or not that might inherit your Social Security over their own, widow benefits, spousal benefits, what you're going to do working during a period maybe between early retirement and actual retirement, or time that you take Social Security. You can't really say there's one recipe that's right for everybody. Everybody's got a different plan, but you need to take the timing of Social Security and make it part of an overall comprehensive plan, not just say, oh, how do I make the most? I'm just going to take it now because I want all I can get now. Or I'm going to wait till I'm 70 because I'll get more if I wait to 70. Well, that's only if you live to 82. Does that make sense? But again, nobody has a crystal ball. You have to make a plan based on the best assumptions you can make and make the decision that optimizes your Social Security, not necessarily maximizes your Social Security.
Jeff, hate to interrupt you, but we're running out of time for this week. If our listeners have questions and maybe they'd like to get ahead of some of these problems before they retire, give us a call here at Premier Retirement, 520-780-9059 to set up your appointment with Jeff. No cost, no obligation, no judgment. Casual conversation, 520-780-9059, or you can do it online at premrat.com. Out of time for this week, Jeff. Thanks so much for your time, but as every week, I want to thank our great listeners here in the greater Tucson area for joining us. So for Jeff Hogan, I'm Jeff Shade. Have a great weekend. Stay cool. We'll talk to you again next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy, and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.